Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down the biggest TFSA mistakes to avoid in Canada. The TFSA, the tax-free savings account, is one of the most powerful investing tools available to everyday Canadians, but the rules can be confusing and a lot of Canadians are not using the TFSA to its full advantage. In this video, I want to address some of the most common mistakes and misconceptions about the TFSA that you might not be aware of and could be costing you a lot of money in the long run. Make sure you watch my previous video, TFSA Explained, where I go over how the TFSA works, the rules to follow, your contribution limits, and my investing strategy to get the most out of your tax-sheltered growth. Click the pop-up at the top right or click the link in the box below to watch that video first to learn what you should do in a TFSA. This video is all about what you should not do in a TFSA. As a super quick summary, the TFSA, or tax-free savings account, is a tax-sheltered account where you can hold investments like stocks, bonds, ETFs, and REITs, and all of the investment income that you earn will be tax-free. This is a huge benefit since any dividends, drips, or capital gains that you earn will be totally tax-free, and that allows your investments to grow much faster than they would in a non-registered account. The only catch is that there is a limited amount of contribution room. If there wasn't, then everyone would just put all of their money in a TFSA and never pay any taxes on their investments. Since there is a limited amount of money that you can put into a TFSA, you have to be strategic and make that contribution count. And that takes us to our first mistake, using the TFSA as a savings account. And this isn't your fault. The name itself is misleading. It's called the tax-free savings account, but really it should be used as a tax-free investing account. The real power of the TFSA is to invest in the long term and let your investments grow and compound tax-free year after year. But if you use your TFSA as a fancy savings account, as the banks suggest, your money will not grow. With a savings account, you give your money to the bank, and the bank uses your money to invest and make themselves rich. As a small thank you, the bank pays you a very small interest rate. Interest rates are historically low, so your savings account at a big bank will pay you around 0.05% in interest. That is pitiful. Right now, the best savings account in Canada is EQ Bank, which is my personal favorite, but even so, they only pay out 1.25% in interest. This is the highest interest rate you'll find in Canada, and it still doesn't keep up with inflation, which is usually around 2% every year. GICs are about the same, with most offering about 1.5% interest for a 5-year term. So if you keep tens of thousands of dollars in a savings account or in a GIC, your money is remaining flat, or even losing value every year due to inflation. And holding savings and GICs in your TFSA is a total waste of that precious contribution room. These interest rates can only pay you up to 1.5% every year in income, and so you would barely be paying any taxes on this anyway, and so a TFSA would be wasted. Instead, if you put investments in your TFSA in established stocks, ETFs, and REITs, you could reliably earn 7% or higher every year, and so the taxes you would save off this higher income will give you a much greater tax benefit, especially in the long term. Check out my video on how to build wealth in Canada, where I stress the importance of establishing an emergency savings fund, and a high interest savings account like EQ Bank is the perfect tool for that. So click my referral link in the box below to open an account. But to build wealth in the long term, the majority of your money should be in investments. Put your investments in your TFSA and leave your savings out of it. With a TFSA, you have a limited amount of contribution room, and it is your responsibility to keep track of how much available room you have. This contribution room does not depend on your income. It only depends on your age. As soon as you turn 18, all Canadians start building TFSA contribution room. Although in some provinces, like British Columbia, Newfoundland, Nova Scotia, and New Brunswick, you actually have to be 19 in order to open a TFSA account. You'll still be building room at 18, you'll just have to wait an extra year to open your account. Currently, every Canadian earns an additional $6,000 of TFSA contribution room every new year on January 1st, and this will likely continue in 2022. Even better, unused contribution room is not lost, it gets carried forward, so don't worry if you can't max out your TFSA every single year. If you don't want to calculate your contribution limit by hand, feel free to use my handy table to find out your maximum available TFSA contribution room based on your age right now in the year 2021. If you were born in the year 1991 or earlier, meaning you will be 30 or older this year, you have a total of $75,500 of available TFSA contribution room. That means if you have never added money to your TFSA, you can put this full amount into your TFSA in the year 2021. Looking at the bottom, if you were born in 2003, meaning you are turning 18 this year, you will have $6,000 of TFSA contribution room. Here's a question I get all the time. You do not need to be a Canadian citizen or even a permanent resident to open a TFSA. As long as you live in Canada and have a valid social insurance number, you can open up a TFSA account, even with a work visa or a student visa. However, you only start building TFSA room once you actually live in Canada. So if you're 35 years old, but you just moved to Canada last year, you don't get the full $75,500 of TFSA room. You would only have $12,000 of TFSA room, the same as a 19-year-old. You earned $6,000 in 2020 when you moved here, and another $6,000 in 2021. I've gone over in detail the rules with TFSA contributions and withdrawals in my TFSA Explained video. But remember, every time you contribute money into your TFSA, that takes away from your available contribution room. And when you withdraw money out of your TFSA, you will regain that withdrawal amount, but only next year on January 1st. It is your responsibility to keep track of your available room and to ensure that you do not go over your limit. This is a common mistake. Do not rely on your bank, your broker, or the CRA to tell you your available room. That's your responsibility. If you log into your CRA account online, you will see your TFSA available room, but this number is not up to date. The CRA will only list your TFSA room as of January 1st. It will not include any contributions or withdrawals you've made since then, so do not rely on this number. Once a year during tax season, the CRA will gather all of your TFSA transactions and post your available room in February or March, but this number is only updated once per year. So use this number during tax time to confirm your own records, but for the rest of the year, it's your responsibility to record every single contribution and withdrawal that you make from your TFSA. This way, you will always know the exact amount of available room to ensure that you don't over-contribute, because if you do, the penalties will be severe. If you exceed your TFSA contribution limit, you will be charged a penalty of 1% every single month on this excess amount. That's 12% a year in fees. That's huge and almost as bad as credit card debt, so please avoid this. There's no investment that's worth a guaranteed loss of 12%, so stay within your limit, and please make sure you record every time you put money in or take money out of your TFSA. One of the most common mistakes that gets people in trouble is withdrawing and recontributing to your TFSA in the same year. You can withdraw money out of your TFSA and it will be tax-free, but you don't regain the contribution room until January 1st of next year. Let's say you're close to maxing out your TFSA and you only have $10,000 of available room left, but then you decide to withdraw $30,000 to buy a new car. Your available TFSA room does not increase when you make this withdrawal. You only regain this room on January 1st. Until then, you still only have $10,000 of TFSA room available. Let's say you change your mind and you're not going to buy yourself a new car, and now you want to put that $30,000 back into your TFSA. Well, you can't do that for the rest of the year. You only have $10,000 of available room. So if you put that $30,000 back into your TFSA, you've just exceeded your TFSA limit by $20,000. And now you'll be charged 1% or $200 every single month until you withdraw that excess amount. When the new year comes around on January 1st, that's when you regain that $30,000 of TFSA room that you withdrew, plus an additional $6,000 since it's a new year. That's why I suggest, if you have to make a withdrawal from your TFSA, do it at the end of the year in December. That way, you only have to wait a few short weeks to regain that contribution room. If you withdraw from your TFSA in January, you'll have to wait a whole 12 months before you can put that money back in. Check out my year-end tax saving tips, where I go into this example and other tax strategies in greater detail. It's very important to remain below your TFSA limits, but another common mistake is being too cautious. You are only limited by the amount of money you can put into your TFSA. There's no limit on how much it can grow once it's inside. So let's say you're 25 and your TFSA limit is $50,000. If you put in $40,000 and your investments grew to $60,000, you're totally fine. You have not exceeded your limit. You earned a profit of $20,000 from capital gains or dividends, but that money was earned inside the TFSA, so you get to enjoy that money fully tax-free. In fact, you still have $10,000 of contribution room, so your TFSA isn't even maxed out yet, even though on paper, your TFSA portfolio is worth more than your limit. Your contribution room only dictates how much money you can put into your TFSA from the outside. Once that money is in your TFSA, it can grow tax-free and it does not affect your contribution room at all. Another common mistake Canadians make is withdrawing from their TFSA instead of simply transferring to another broker. Let's say you have a TFSA savings account or investing account with one of the big banks and you've had enough of their high fees, so you decide to transfer your money into QUESTRADE, which is my favorite online broker. The wrong way to do this is to withdraw the money out of your bank's TFSA and then contribute that money back into your QUESTRADE TFSA. This will count as a withdrawal and a contribution, and as we already talked about, if your TFSA was already maxed out, you'll have to wait until January 1st in order to put this money into your QUESTRADE TFSA account. Instead, request a transfer through QUESTRADE. That way you can move money or stocks from your bank into QUESTRADE, and since that money is never leaving your TFSA umbrella, it does not count as a withdrawal or a contribution, so it doesn't affect your available room at all. Plus, QUESTRADE will reimburse you your bank's transfer fees up to $150, so it won't cost you a thing. I have a whole video tutorial on how to transfer from your bank into QUESTRADE, so make sure you check that video out. And if you'd like to get started with QUESTRADE, click my referral link in the box below and you'll get $50 in commission-free trade rebates for the first 30 days when you sign up. That basically means that your first 10 stock trades will be commission-free. That saves you $50, plus I'll get a small referral bonus as well. Another common mistake is not maxing out your TFSA right away. There is no downside to contributing to your TFSA, so you should definitely try your best to max out your TFSA every single year. If possible, max it out right away in January when you get that new TFSA room. The sooner you put money in, the longer your investments will have to grow tax-free, and that's how wealth is built in the long term. Unlike some accounts, like the RESP, there's absolutely no benefit at all to pacing yourself with the TFSA. In my RESP explained videos, I talk about how you should only contribute $2,500 a year in each child's RESP in order to max out that free government grant money. But with the TFSA, there's no reason to wait. And you shouldn't be investing in your non-registered or margin account if you have TFSA room available. Why pay taxes on your investments when you have tax-sheltered room waiting for you? There are some exceptions to this, since some investments should not be held in a TFSA, and that leads us to our next mistake. Do not hold risky or speculative assets in your TFSA. These include penny stocks, cannabis stocks, IPOs, crypto ETFs, anything that's incredibly volatile and likely to crash and burn. If you don't think the stock will be around in 10 years, you shouldn't put any serious money into it, and you definitely shouldn't put it in your TFSA. It's okay if you want to gamble with risky investments, but only do it with a small amount of money that you are 100% prepared to lose, and do it in a margin account. But please don't gamble in your TFSA, because if your penny stocks crash, not only will you lose money, but you will permanently lose that precious TFSA contribution room, and you never get it back. Let's say you put in $20,000 into your TFSA, and you buy risky penny stocks, and then they crash. Now, your $20,000 investment is only worth $5,000. So you've just lost $15,000, and you'll never get that contribution room back. You didn't withdraw $15,000, you just lost it on a bad investment, and so you don't get to regain that contribution room next year. In the government's eyes, you put in $20,000 into your TFSA. They don't care that's only worth $5,000 now. And now your TFSA will always be $15,000 behind someone else who didn't lose that money on risky stocks. And if your TFSA is maxed out, you can't put any more money in to catch up. You're always going to be that much behind. This also goes with selling any stock at a loss. In a non-registered account, like a margin account, there are benefits to selling a stock at a loss. You can claim a capital loss, which can reduce your tax bill, as I talk about in this video. But in a TFSA, you don't get this benefit. If you sell a stock at a loss in a TFSA, there's no upside at all. You just lose money and you lose that contribution room. If you believe in the long-term future of a company and the stock price falls, don't panic and don't sell. Wait for it to recover, especially in a TFSA. A common reaction is thinking, if I cash out and sell this stock, I can buy a new stock that will grow quickly and make up for my previous loss, but it's not that easy. If your stock drops by 50%, to get back to where you started, finding a new stock that will grow by 50% is not enough. Your new stock will need to double or go up by 100% just to break even. That's very hard to do, so instead, don't sell. hold on to that stock and let it recover, as long as you truly believe in the long-term future of the company. So if you really want to gamble with risky and speculative investments, do it in a non-registered account. Your TFSA should contain quality, established, and secured stocks and ETFs. And if your stocks pay out dividends, focus on Canadian dividends in your TFSA. You should avoid US dividends inside your TFSA, and that's because US dividends will be charged a 15% withholding tax in your TFSA. This may be a surprise, but the TFSA is only truly tax-free when it comes to Canadian investments. US dividends are not fully tax-free. If you own US stocks or ETFs which contain US stocks in your TFSA, those dividends are taxed 15% immediately when you receive them. So if you are supposed to collect $100 in US dividends, you'll only actually receive $85. The US government automatically takes that 15% away. You don't need to file a tax return with the IRS. Instead, you should hold your US dividend stocks and ETFs inside your RRSP. That's the only way to avoid this withholding tax. Because of the US-Canada tax treaty, only registered retirement accounts like the RRSP, RIF, or LIRA are exempt from these withholding taxes. The TFSA is not. I talk about this withholding tax in greater detail in my RRSP explained videos, so check those out. Important note, these withholding taxes only apply to US dividends. Capital gains are always 100% tax-free in a TFSA, even from US stocks. So a US growth stock that doesn't pay a dividend, like Amazon or Tesla, will be totally tax-free in a TFSA. But if your US stock pays out a high dividend yield, you should probably hold it in your RRSP instead to avoid any taxes on it. Finally, you should avoid day trading in your TFSA. Day trading is whenever you buy and sell stocks multiple times throughout the day, trying to earn a profit from short-term gains. I do not recommend day trading, especially for beginners. It's incredibly risky and it's very easy to lose a lot of money, especially if you don't know what you're doing. But if you are determined to try it, you are not allowed to day trade in a TFSA. The TFSA is designed for long-term investing, but day trading is not investment income. Day trading is business income, and so the CRA does not allow it. A business can't open a TFSA. TFSAs are meant for people. If the CRA audits you and discovers that you are day trading in a TFSA, they will tax you and they will penalize you. So don't do it. You don't want to make an enemy of the CRA. And they are intentionally vague about what they consider day trading. They don't disclose a number or a threshold, since if they did, people would just take advantage of it. Remember, the TFSA is designed for long-term investing. So as long as you aren't buying and selling stocks within a few hours and doing this every week, you should be fine. So there you have it, guys. Those are some of the biggest mistakes to avoid in your TFSA. Don't waste your limited room with savings. Keep track of your contribution room and never exceed your limit. When you make a withdrawal, you'll have to wait until January 1st to regain that room. Your profits don't eat away your contribution room. You're only limited by the amount of money you can put into your TFSA. Max out your TFSA as soon as possible, and when moving money from your bank to your broker, do a TFSA transfer, not a withdrawal. And avoid risky investments in your TFSA, and don't try day trading. Finally, avoid US dividends in your TFSA. Hold those in your RRSP instead. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at CanadianTShirt, click the link in the box below, or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.